What if I told you that a single piece of software quietly watches over more money than the economies of most countries combined? Not a government, not a bank, not a billionaire, a machine. Every day, trillions of dollars move through the global financial system. Pension funds, governments, banks, insurance companies, investment giants. And behind many of those decisions sits a powerful AI platform known as Aladdin. Most people have never heard of it, yet it influences investments that affect millions of lives. Retirements, mortgages, entire economies. Some call it the most powerful financial system ever created. Others call it a ticking time bomb. Because when too much power is concentrated inside a single system, one question becomes impossible to ignore. Who is really controlling the market? And what happens if the machine gets it wrong? To understand Aladdin, you first need to understand a problem. Modern finance is impossibly complex. A single investment fund can hold thousands of assets: stocks, bonds, real estate, currencies, commodities. Every asset carries risk, and every risk can trigger another. A war starts, interest rates rise, a company collapses, a government defaults. Suddenly billions can disappear overnight. Now imagine managing all of that manually. You can't. Humans simply aren't fast enough. So Wall Street built machines. But one machine became different, far more powerful, far more connected. Its name was Aladdin, short for Asset, Liability, Debt, and Derivative Investment Network. A system designed not just to track investments, but to understand risk itself. And over time, Aladdin became something much bigger than anyone expected. The story begins after disaster. In the late 1980s, financial markets were becoming more complicated. New financial products appeared everywhere, and many investors had no idea how much risk they were actually taking. Then came market shocks, losses, unexpected failures. The financial world needed a better way to see danger before it arrived. That's where BlackRock entered the story. Founded in 1988, the company built a system focused on one thing: understanding risk. Not after disaster, before it happened. The project eventually evolved into Aladdin. At first, it was simply an internal tool, a sophisticated risk management platform. But then something unexpected happened. Other institutions wanted access, then more institutions, then even more. And soon, the tool that was supposed to help one company understand risk began spreading across the entire financial world. And that's when Aladdin's influence exploded. Here's where the story becomes unsettling. Aladdin isn't powerful because it's intelligent. It's powerful because everyone trusts it. Imagine thousands of investment managers waking up every morning and opening the same system, looking at the same risk models, reading the same warnings, following the same signals. That's influence. And influence becomes power. Aladdin analyzes enormous amounts of financial data. It helps institutions evaluate investments, monitor risk, stress test portfolios, and react to changing market conditions, all at a scale humans could never match. But there's another layer. The more institutions that use Aladdin, the more central it becomes. And the more central it becomes, the more important its decisions appear. It's a feedback loop, a financial network effect, one that quietly expanded for decades until it became deeply embedded inside global finance. And by this point, its reach was almost impossible to ignore. Now for the number that shocks almost everyone. The assets managed or monitored through Aladdin have been reported in the tens of trillions of dollars. Not millions, not billions, trillions. A number so large it's difficult to visualize. If Aladdin were a country, its financial influence would rival the largest economies on Earth. Think about that. Retirement savings, government funds, insurance assets, institutional portfolios, all flowing through systems connected to a single platform. And this is where concerns begin, because concentration creates efficiency, but concentration also creates vulnerability. The larger a system becomes, the more important it is that nothing goes wrong. And history shows that even the smartest systems can fail, which leads us to the most controversial part of this story. Critics have a simple concern. What happens when everyone uses the same map? Imagine thousands of pilots flying through a storm, and every pilot relies on the exact same navigation system. If the system works, everything is fine. But if it fails, everyone could make the same mistake at the same time. Some experts worry financial markets face a similar risk. If too many institutions rely on the same models, the same assumptions, the same warnings, market behavior could become increasingly synchronous.